Good day. It's Tuesday, September the 28th. I'm Martin Gagel with Market Radius Research. Today, we've got Frédéric Dugré of H2O Innovations on the call with us. This is a special financial year-end earnings call that I'm doing with Frédéric. We did this on his last quarter, and we're going to go over his year-end financial presentation, and we'll ask questions along the way to dig into some of the salient points. From my perspective, the Frédéric and H2O, the whole team there, has done an impressive job where we've seen revenue growth, as gross margins have expanded, EBITDA margins have increased, and recurring revenues has increased. So these are all falling into the 3-year strategic plan that the company put out earlier, and it seems to be coming along as expected. So we'll get Fred to walk through his presentation deck, and I'll ask some questions, and we'll discuss some of the topics along the way. So Fred, thank you very much for joining us, and let's get the overview on the quarter and the year.
Well, thank you, Martin. As you have pointed out, I mean, it has been a great year, a challenging year, let's put it this way, going through the COVID pandemic. But you mentioned also we're checking boxes, month after month on our 3-year plan, strategic objectives that we have set. So big improvement when it comes to financial performance. Balance sheet is getting stronger and stronger. We have been able to do 2 acquisitions in the last fiscal year only. So this is terrific. I mean, even though we have to deal with the constraint of non-traveling and all these business challenges, we have been able to do 2 acquisitions, one in Texas, one in Spain. On top of that, as you pointed out, we keep increasing our recurring sales. Last year was a strong test on our business model, and we validated that, it is truly more predictable. It is sticky business. We have now 87% of our revenues that are recurring by nature. When we look at the O&M, combining with services, combining with specialty products. So the business model is really, really solid. If you look at the performance now of each of our business pillar, starting with the WTS, really, we're starting to see things moving now finally in the right directions. Yes, we have, I would say, quote unquote, fixed and improve the profitability of that business pillar. But now we're starting to see that revenues are now going in the right direction as well. And I don't think it takes much to understand that currently the 34 projects we have under engineering phase, so it is projects that we're currently working on, will become under fabrication phase. So this is where and when we're going to recognize the large bulk of the revenues that will impact the coming quarters. So it is just a matter of time before we see the shift from the 34 projects in engineering phase going into fabrication phase. This is when we're going to see a ramp up nicely into the revenues. So this is something also that we're going to see in the coming quarters. I have to say that the backlog in terms of the diversification, the effort spent towards having more and a greater proportion of industrial customer is also paying off. It comes with higher margins, revenue recognition for industrial projects is usually faster because we can deliver them on a faster fashion. So it is also something very beneficial. So really,
Fred,
yeah.
Sorry, just for clarification here, all of in this engineering, fabrication, commissioning, and piling, these are all projects you've won, and they're just the different phases that you work through until you finalize it. And
that's right.
You generally do a percentage of completion basis, and the most of that is done in the fabrication side. So in engineering, you've got 34 projects that you're engineering, trying to work out, and then you recognize a little bit of revenue there, but the bulk of the revenues that you recognize happen during the fabrication phase.
That's correct.
Gotcha.
Typically, and in a project itself, the engineering phase will represent between 5 to 15% of the overall value of a project. So let's say we have a $1 million job, we may be able to recognize about, let's say, an average of 10%, so $100,000 on the engineering phase. So when we develop the drawings, when we develop the process flow diagrams, when we develop all the control narratives, when we provide the submittals, once we get the approval from the customer saying, yes, I'm comfortable with the design, let's move to the fabrication phase. This is when we usually recognize 70% of the revenues. And this is when we start to order material, go to the supply chain, start to fabricate, start to assemble. And this is when, we see the ramp up into the revenues. So it is just a matter of time before these 34 projects will move from engineering and will hit our fabrication facilities in the US and in Canada.
So, and just to be clear, currently you've got 34, and last year you had 17, or that's an increase of 17 from last year?
It's an increase of 17 compared to last year.
Okay, and then last quarter you had 32, so it's increased by 2 from the last.
From March, exactly.
Gotcha, okay.
So this business is growing. I truly believe that we are into an inflection point for growth on that business pillar, definitely.
And this is typically your lowest margin business as well. But you talked about that you are kind of targeting the higher margin projects within that lower margin world. And then also it's not just, they are one-off, but they're not one-off, is they often lead to a recurring O&M kind of situation afterwards where you get sort of a trailer.
Yes, and if it's not for, say, the O&M, it will be certainly the service side that is going to benefit, from punctual services that we're going to perform on this customer. But you're right, it is usually the lower margin end of our business. But now with discipline, with focus, and improving our project execution, we have shown improvement over the last couple of years.
Yeah. And I presume some of the margin improvement is happening as well. Just as you get bigger scale, you have bigger purchasing power, and you have the economies of scale to drive it better.
That's right. A combination of all these factors. And as I said, the profile of customers also that we're chasing, the fact that now we're working on this large industrial customers for the largest electrical car manufacturing in the company in the US, sorry. So these kinds of customer profile, we did a couple of years ago projects for a big server farms, a big, I would say, commercial, digital commercial company in the US as well. Within another one for Philip Morris, Cummins, and all these large industrial customer profile help us, to come up with better margin.
And typically from the early engineering stage to the piloting and finalizing of it, what is that typically a year or 6 months, or what's the sort of typical time frame?
Well, to the commissioning, it can vary, but typically for industrial customers will be like 12 to 18 months. Municipal might be a little bit longer, might be 18 to 24 months.
Yeah.
Sometimes it's a long process for revenue recognition. Gotcha.
All right.
And as we said, there's a lot of things currently happening also in the background of that, in a sense that, we're pushing for innovation tremendously. I don't know if you remember, but I would say 2 years ago, we announced and launched this new technology, the silo, an MBR package plan for wastewater treatment. Now, finally, last year, we have been able to deliver the first tangible wastewater plant of this kind to an industrial customer also in the Midwest. We think that this is going to snowball for this year with more of the silo that we're going to install. Similarly, also, we have expanded the portfolio of offering with new membrane technologies, EDI, ceramic, again, pursuing new opportunities, new application also. And you see that, the progress and the work done behind the scene also to keep striving for growing the service side of our business. Into our business model, what we're trying to do is that we're trying to do everything we can to keep this customer. Once we have it, once we have delivered this equipment, that's what I'm telling my team. Let's do everything we can to preserve this customer, make sure that we're going to sell him services, parts, consumables, eventually, as you mentioned, operation and maintenance. And you see that it has paid off. This focus that we have has paid off, because last year we have seen a growth of 12% into the service side of our business. And this is coming up with better margin as well. So not only we're serving better our customer, we're retaining them, but we're improving also the financial performance of the company by coming up with a service that comes with high margin. So
there was and you talked about this on the call, there's a slight decline in the project revenue year over year. Is that partially, is that some foreign exchange impacts hitting that? And, or is that maybe some COVID related issues, just harder to sort of execute on the delivery of equipment during the whole COVID chaos?
Well, it was a little bit more about the FX impact. I mean, we have seen a little bit of delay, but nothing significant on that front for this particular business pillar. I mean, our service team has continued to perform services. There was a little bit of delay at the beginning of the pandemic, you know, because everything was shut down for the commissioning of new projects because we couldn't access field work, you know, on the different sites, construction sites. On the other end, it has resumed. So the pressure that we saw, or the offset we saw in this business, the business growth, was mostly driven by foreign exchange on this side. And
in your strategic plan, you are not as focused on driving the project hardware business as much as you are on the other side. You're a little more choosy on that side of the business, right? Where you get sort of the right projects, where you get the right margins and that.
Exactly.
You'd much rather push the other business. This is an integral part. It sort of feeds the rest of it, but you're not just getting any business just to get it.
Quality of revenues more than quantity of revenues. Yeah. That's what we're going after, and quality being, you know, better margins or opportunities that drives additional visibility for service or consumables or operation and maintenance. So I might be inclined to say, well, you know what, I may sacrifice a little bit points of margins on a capital equipment project because I know at the back end of it, I'm earning, you know, the operation and maintenance 5-year contract, right?
Yeah.
But what we're trying to do, as you just mentioned, is stay disciplined and pursue opportunities at better margins.
All right.
Specialty products was also a super busy year. I mean, even though we couldn't travel as we wanted to because it's mostly an international business with a lot of distributors around the world, we have been busy making an acquisition in Spain that we have announced in February to further expand our offering for product and services, to expand our business in Latin America very aggressively, and give us a platform with our office now in Chile, Santiago, to further expand business for the mining industry, which is in terrific need for water, obviously. So we think that this move of this acquisition is going to definitely pay off. It has started to pay off and will continue to pay off in the coming years. So we will see, you know, also an acceleration into the growth, because last year, frankly, we couldn't do any hirings of new salespeople into that organization. It is an international organization and we couldn't travel. So what we did was mostly to play defense and make sure that we provide and keep, you know, what we have as a relationship, make sure that we keep, you know, services going to our existing customer and existing distributors. But this year, this new fiscal year started just on July 1st, we already came up with hiring of key people. And this is going to pay off. This is going to help us to better coordinate and expand our business.
We're going back to into the Latin American with the completion of the acquisition of Genesis. This is really your big first footprint in Latin America, correct?
Tangibly, yes. We had distributors before, but not a formal office with staff. Now we have 8 employees in Santiago, Chile.
And are you going to be able to leverage that office and your distribution and contacts you're making down there now to maybe get more of the WTS business and sort of leverage other opportunities out there? So Latin America views you as sort of this full service provider, or are you just going to kind of stay with the specialty products down there?
Well, short term, we're going to stay with the specialty products. I mean, let's try to first consolidate and leverage what we have out there, you know, because the low-hanging fruits will be to have, you know, PWT, Genesis, and Piedmont working more effectively together. And this is what we're trying to do. And this is why we hired this guy, this veteran in the industry, Alejandro Soniolo, to start to help us to better coordinate things with Latin America. He's coming from Argentina himself. So he's going to help us to coordinate that and grow our footprint and be more effective in the synergies we can capture within this business pillar. Now, are we going to be opportunistic from time to time on specific capital equipment opportunities? Yes, maybe. But short term, I think, you know, there's huge upside that we're going to capture from the not the install base, but the distribution network we have right now in Latin America.
Okay, so you're going to sort of make that more efficient, get that to its best, and then maybe a couple of years down the line, then you'll use that platform then to maybe drive some of the other lines of business down there.
Exactly.
All right.
You see, Brazil itself is a huge country with full of opportunity, right? And we were not really present, and we just signed, our first distributor out there for Piedmont. So we're taking steps, to first establish ourselves, have proper representations, and start to leverage that furthermore.
All right.
And something that is great also is the current expansion that we have announced. It was announced, but I think it went a little bit under the radar. But we're so happy that we took steps earlier last year to expand our manufacturing capabilities. We added 40%. The picture you see there, the little orange that you see on this picture, is the current expansion on our manufacturing capacity. This will allow us to cope with the expected growth coming from the maple industry. The Quebec government is going to release 7 million of new taps, allowing the farmers, allowing the producers to increase their production. So for sure, in the coming 3 years, as they release these taps, the producers and the farmers will be adding more equipment. They'll be buying more equipment. So we wanted to be ready to cope with this coming growth. And also the fact that our manufacturing plants that you see there is also supporting the WTS when it comes to manufacturing and assembly of equipment. So if you look at the two, the growth coming from the maple, the growth expected, as I said, from the project moving to engineering to fabrication, we're going to be super busy and we'll need space. So this is why, this investment was done and it's currently starting to pay off.
And Fred, the maple industry in Quebec is it's like a managed market, kind of like the dairy industry. The government gives quotas, and then there's a buying group that buys it all and does the distribution. And they've basically said, I guess the market can handle more of our products, so we're going to expand production.
That's right. So several years ago, it was disorganized, right? I mean, you were a producer, you were selling your maple syrup that you produce yourself to the open market. And Quebec used to produce 90% of the maple syrup internationally. Now, what the Federation has helped was to better coordinate the supply and the demand. So in terms of supply, they have agreements with producers to ensure the buying of the maple syrup produced. They store it into the facilities, and then they export it elsewhere at specific price. So they control now, they have stabilized the price of maple syrup. Now, on the other end, the US market took several steps to increase their capacity. So they went from Quebec had 90% of the production, they were down now to 65, 70% of the global production because US has been growing tremendously over the last years. So now I think Quebec wants to take additional market shares and ramp it up again. And this is why they're taking steps and issuing these new quotas in the 7 million new taps that we're going to release.
All right.
So this is exciting. We'll see how it goes in the coming year. Finally, the operation and maintenance business pillar. Fantastic year, super busy. Started with the acquisition of Gulf Fertility Services, allowing us to consolidate our business around Houston area. With a greater number of customers. We have also merged the 3 brands that we have. So Utility Partners, A's, and Gulf Fertility Services became one brand of H2O Innovations. So altogether, these little things that we have done have allowed us to improve our operational excellence and altogether improve the efficiency and improve the profitability of that business pillar. So really happy of where we are. I think if you look at the overall market, the way it's growing, it's growing at 3 to 4% a year. We are extremely well positioned to beat that in the coming year. We're starting actually the year with a fantastic track record. I mean, we already secured last year new project, but also early this year we just announced. I'm sorry. We just announced in July a new project for the city of Laurel in Mississippi, a 4-year contract for a total value of $10 million that we're going to add. So within the first months of this new fiscal year, we started a new O&M project for the city of Warren in Rhode Island. We started the city of Laurel in Mississippi, and we have tremendous renewal rate onto our business. So we know for sure that this business will be growing tremendously this year. Now, the challenge is related to this large project we have in the backlog. I think this is the thing that we need to focus on. The backlog went down actually at 70 million compared to what it was last year, essentially due to the fact that there is this large $10 million job each year that is coming up now finally for renewal, and it is happening this year. So right now it's all hands on deck to make sure that we're going to renew this project. And so far, obviously our track record was tremendous. It's a customer of us in Mississippi that we had for 15 years. So we're doing everything we can to preserve this customer, and I think we're well positioned to do it.
And this business, is it exclusively in the US, or do you have any Canadian O&M business?
We do have operation and maintenance also in western part of the country, around in Alberta, around Calgary.
Okay.
So we started with first project with the operation of Kananaskis, the provincial park. But since then, we added like 4 new operation and maintenance contracts within, the greater Calgary area, including 1 new industrial customers that we just secured in April last year. So all this is also starting to pay off really nicely.
Who do you compete with on that? Are there big conglomerates, or is it just little regional companies that you're up against on those, or are you competing against internal operations where a city goes, we're not good at managing water, let's hand it off to the professionals?
Well, it's 2 things. I mean, we're seeing 2 types of competitors. We're seeing, the conglomerates of the world that you're talking about, and that's number 1. Veolia and Suez, the French companies, they have merged together now. They became one company. So this is by far the largest contract operator. But also in the US, there's 2 others. There's Inframark, who's owned by a private equity fund in New York. But there's also a division of Jacobs, which is a large engineering firm, previously CH2ML. So they have an operation and maintenance arm that they operate. So we believe that we're right in the right point. I mean, we have the advantages of a small company being nimble and being fast and being agile, and we don't have the disadvantage of a large corporation. However, we have all the competency and expertise of a large conglomerates because of our different business pillar, which usually a small company won't have. So I think we're very unique and well positioned to capture more and most importantly, preserve our existing business.
All right.
I think this slide is probably my favorite one of the entire deck. Well, obviously it makes me feel good on how we have progressed over the last several years, and it's amazing to see how time is going fast and how we have transformed the business year over year. But we keep showing, growth. You see 5-year revenue compound annual growth rate of 23%. Yes, combining organic and acquisition, but it's still terrific. And same thing with EBITDA. We have just expanded our EBITDA year over year in the last 5 years, 38% growth in the last 5 years. So we keep striving to improve that. Last year, even though it was a challenging year due to COVID, I think we have done a fantastic job. We keep capturing, different synergies between our different business pillars as well and business lines. So really happy of our progression overall.
Fred, this is sort of a silly question, but just trying to analyze or understand how COVID did change things. Let's say there was no COVID last year. How do you guess your financial results or your business would have been different? What have you seen? A lot different levels of growth on different. Did it retard your revenue growth? Did it increase your costs or?
Well, I think we'll have been slightly higher on the revenue side. We will have definitely probably take took steps earlier to add more people on growing our sales team. But there was no point in doing it because we couldn't travel anyway, as I said, because it's an international business. So I think this would have been one thing. Yes, we have seen exposure or pressure on pricing more and more. If there was no COVID, I mean, I'm sure that, you know, freight and logistics wouldn't have been to what it is now. We would have been able to probably expedite more goods and more products at the year end, enabling us to slightly increase the revenues. Now, it's not revenues we have lost, they're just pushing time to the following quarter, but still. And the other thing, as you mentioned, is the pressure and increase in inflation, crazy inflation on different kind of material. So I think if it wasn't from the COVID, we would have been able to probably more focus on growing the business than try to play defense again and manage the supply chain and manage, you know, the logistics issues. But otherwise, it is what it is. At the end of the day, you know, I'm always, you know, looking at it on the two sides. I mean, this is a threat. There are threats out there coming out of this COVID and coming out of this pressure and shortage on some raw material. On the other hand, it creates an opportunity. And I think, you know, for example, there is a great opportunity to further push, I think, our green chemistry. This morning on the call, I was mentioning, to answer one of the analysts, we were talking about some shortage coming from one raw material made out of phosphate. And the shortage actually is creating an inflation of 40% into the cost of phosphate itself. And most of the chemicals out there into our industry for antiscalants are using phosphate-based solution and chemicals. And this has been done forever. The cool thing is that our PWT SpectraGuard, which is an equivalent chemistry, is a green chemistry. It doesn't have any phosphate. It's made out of another polymer, the dendrimer, that we make ourselves in California. So now we have a unique opportunity to push that further and try to convince our customers to adopt this new green chemistry, not only because it's out of phosphate, but because also it comes with a super high concentration formulation, allowing us to reduce by 11 times the cost of freight because it's an 11 times concentrated product. So the threat could create an opportunity for us for one of our business line. I think it's like that for everywhere in all businesses. We just have to be smart. We just have to be opportunistic and work hard. And this is what we're going to continue doing.
All right. On another part of your strategic plan is on the acquisition front. You did a couple of acquisitions last year. You have discussed on your earnings call today that the valuations for acquisition seems to be going higher. I guess a lot of people are seeing the opportunities in the water space. Could you talk about that? Like maybe how that's affecting you guys, or any thoughts on that sort of M&A and generally the rise in valuations all over the place?
Yes. Well, again, there was inflation everywhere, including M&A. First, I think we're positioned, H2O Innovation itself, without looking at the market and inflation on multiples, extremely well. Our capital structure right now, if you look at our net debt, we're finishing the year end on June 30th with $500,000 into net debt. So as we speak, you know, if we look down into a quarter with the schedule of reimbursement on our loan, we'll be virtually at no debt, right? So first, we have room into our balance sheet to conduct our plan, to conduct our 3-year plan and acquired tuck-ins, acquired companies, and up to maybe 2.5, 3 times, you know, leverage on the debt, on the EBITDA, sorry. Now, as you just mentioned, there is a crazy valuation on the companies out there. The water sector, I think, with the fundamentals is becoming, you know, a sector of interest for many investors, including private equities, including pension funds and all that. They want to participate. They're eager to acquire companies in the water space. Now, obviously, it creates an inflation on the multiple paid. What we used to see around, you know, 5, 6, 8, 9, 10 we have seen inflation going up to multiple of 15, 16 times EBITDA. So this is currently happening. However, we want to remain disciplined. We want to remain selective in the opportunities, and many opportunities we're going after, because I think there's a lot of volatility out there. But the water space is very appealing to investors.
So I'm thinking that the way you may adjust the your strategy to this, because you've always talked about being disciplined within the M&A space, is that may push you, like, maybe you're not going to target the bigger opportunities where there'd be more competition towards, maybe go after smaller ones, or then maybe, and I'm just throwing something out there, maybe something in Latin America where you're trying to build a base there, and that's probably not as much on people's radar as there something would be in North America or in Europe.
Exactly. So the typical company, let's say of 100, 150 million, privately owned in the US, proven track record for 15 years, and managers that want to exit because they wanted to retire. The competition you will have from the private equities, from all buyers, it will be like incredible. As you point out, if you go to a sub-market or more fragmented market of smaller companies, still in the US, of 10 to 20 to 30 million, there will be less competition, I believe, into the buying environment. Similarly, if you think outside the box and you go elsewhere, I think also the market, like you mentioned, in South America or Europe, might not be as crazy as it is right now in North America in terms of M&A activity. So we'll have to be smart, but the rule number one, let's stay disciplined. We have a great balance sheet. Let's allocate our dollars properly. Let's grow the company as well organically. We have the room to make investment to grow the company organically. And we're going to find out these companies and we're going to acquire them at reasonable multiple.
All right. Generally, I hate it when people ask this questions, but you're just of the size where it kind of makes sense. You've got over $100 million of revenue. Even if you convert that into US dollars, you should be at over 100 million. You've got a strong balance sheet. A lot of TSX companies have sort of gone NASDAQ south of the border. Is that at all part of your plan, or are you waiting for some maybe other things to happen before doing that?
Well, a listing on the NASDAQ, I think it's more imminent for us and will be like more natural for us to graduate to the TSX. We're still in the venture. I think we check all the boxes in terms of criteria to get listed without having to do a financing. So if we go to the TSX, we'll enter by the front door. Yeah. First. And second, the dilemma of going and getting ourselves listed on the US market, even though I know valuation and the market for small cap is way more important, there's still an important cost that comes with that in terms of overhead. Yeah. So short term, I would prefer to allocate these dollars to our business, to grow the business organically, than having it to report and into another legislation. So first step, I think natural step will be for us, the TSX. I think it's the next logical thing to do. Yeah. And wait, several years from now, what we're going to do with the US market.
Oh, it's easy to forget, given your size and that you're, and I did actually forget that you're on the venture exchange. I would be shocked if they wouldn't let you into that club at this point. It seemed to be material enough to make it there. Fred, I think that's been really good. I think we've covered sort of the main highlights. Is there any points that you want to emphasize that we maybe passed over, or any other sort of year-end or quarter-end highlights you want to point out?
Well, I think we pointed out in a nice way. The last slide we're sharing is just key drivers that we see in the water industry being out there. It hasn't changed. It has just increased. Water demand is just increasing year after year. Population growth, aging infrastructure, even though, there's this huge $1 trillion bipartisan stimulus plan, which most likely will be adopted, with $75 billion going to the water and wastewater infrastructure, it won't be enough. So we are absolutely in the right space. Water scarcity in the southern states is happening and will continue. So we have the right technology, we have the right business model, we can operate, we can design, we can build, we have key products, strong balance sheet. I feel pretty good about the future. We went through this crisis in a remarkable way. So I look forward to travel again. I look forward to acquire more companies and grow the business.
All right, Fred, thank you very much. That was great. Congratulations on the year end and the quarter end. And we'll talk again soon.
Fantastic. Thank you, Martin.
Thanks, Fred.